Warm welcome to all of you. Thanks for joining us. Let me begin by introducing the panel of panelists. So I'll start with Mohit Kulati. Mohit, if you can raise your hand. Mohit takes care of private wealth business for West. He has been with us for over a decade and has overall experience of 2 decades. Then I have Amit Gupta. Now Amit has been adjudged as one of the best research guys in the country and was awarded by erstwhile President of India for his research capability. Amit also manages one of our PMSs as a fund manager with us. He was previously also heading our institutional desk based out of Hong Kong. Then we have Bharat Parekh. Bharat will be basically moderator for the event. So Bharat was previously working with AMC, which was HDFC AMC, along with Prashant Jain, and post that he was managing the treasury of one of the biggest HNI investor in the country. He was managing a treasury of 75,000 odd crores, which is roughly 10 billion in that parlance, right? One of the very large treasuries. And Bharat is heading a products and segment for us. And my name is Manish Mehrotra. I take care of West business for the or business practice for the company. Now we have Mr. Nilesh Shah. I'm not wasting any time in defining Nilesh Bhai because he's beyond words. So yeah. So Bharat, over to you to take it forward.
Thank you, Manish. And good evening and good afternoon, good morning to everyone. I'm sure there are guys across the globe who might be there in this particular call. And, when there's no words to describe what's really happened today in terms of budget and the positivity, the euphoria around it. And I like Nilesh Bhai to throw some light on what's really happened today in terms of the budget and the broad implication of them, and post that we'll get more into a chat and a discussion. Any of you have any questions, please paste it on the chat, and I will ask them to Nilesh as well. So Nilesh, if you can just share what's really your take on what's really happened in the budget today. Vote on accounts budget, we are using it as a loose term, but what's really happened today and how do you really see this impacting the markets and the real economy?
So, Bharat Bhai, as a kid, I'm sure all of us watch this iconic advertisement: owner's pride, neighbor's envy. This budget is truly citizens' pride and peers' envy. India trades at a premium valuation to rest of the peer group. We trade 8 times higher valuation than Russia, 3 times higher valuation than China. Whether we'll overtake China in terms of GDP, I'm not sure. But at this rate, we are likely to narrow the gap with them in terms of market cap. And obviously, that premium valuation demanded very, very good delivery on expectation. And this budget meets all the boxes of expectations and beyond it. Indian economy today faces two challenges. The rural consumption is not growing as fast as urban consumption. The mass market products are not growing as fast as premium product. And the bottom of pyramid consumption is not growing as fast as top of the pyramid. They are all interlinked, they are not independent. This budget creates scope for inclusive growth by continuing certain subsidies, by launching newer things like support for post-harvest agriculture, like support for fisheries, like self-independence in oilseeds, like availability of funding for self-help group across women in rural India. The second challenge for Indian economy is that private sector CAPEX is not growing as fast as government CAPEX. This budget solves that by ensuring that government CAPEX increases by 0.2% of GDP from 9.5 lakh crore capital spending in revised estimate. We are targeting 11,11,000 crore. That's about 17% increase. And yet, through fiscal consolidation, there will be enough credit available for private sector CAPEX. The government has also kept 1 lakh crore corpus for encouraging research and development and innovation in sunrise sector. That also could provide necessary capital for innovation, which in turn will lead to CAPEX over a period of time. And while giving money for inclusive growth and CAPEX, the budget has ensured that we also achieve our path of fiscal prudence. This has been done by removing 0.5% of GDP, which was given as stimulus during COVID, and reducing some expenditure and subsidies. Net net, there is from 5.8% to 5.1% reduction in fiscal deficit. And Bharat bhai, इस budget का एक चीज I really liked. Next year we'll spend about 11,000 crore for infrastructure and other investment, and our net debt hopefully will increase by budgeted number of 11,75,000 crore. There are very few countries in the world where net debt creation is resulting into almost equivalent net asset creation. We are one of that rare country. Could this result into rating upgrade? Who knows? Could this give more assurance to the global investors who are worried about our premium valuation? Undoubtedly, yes. India will get differentiated among the crowd due to prudent policies it is following. Will fiscal consolidation result into negative fiscal impulse? Answer is no, because quality of expenditure is improving towards CAPEX. So fiscal impulse will be still neutral, neither positive nor negative, despite fiscal deficit coming down. Whatever an investor could expect out of a vote on account or interim budget is delivered in this budget. Truly, it is citizens' pride and peers' envy.
Thank you, Nilesh Bhai, for those wonderful explanation. And I was just going through the numbers, and one point which I note is that she's underestimating the number. Is that number is going to surprise and even positive from here? Because on the both factors, whether you look at her estimates of GDP and the tax buoyancy, both numbers are substantially lower. So I was just, is that going to be additional cherry on the cake?
Undoubtedly, Bharat Bhai, the 10.5% nominal GDP growth could go little higher, 0.5%, 0.75%. Tax buoyancy this year is 1.4. Next year, we are assuming 1.1. So there is a reasonably good chance. We have even provided 15,000 crore for support to oil marketing companies, whereas this year we have made it zero from 30,000 crore because OMCs are profitable. Yes, there could be something here or there in terms of under or overestimation, but it's not material. And most importantly, Bharat Bhai, when PSU market cap was 15 lakh crore, we were looking at 50,000 crore divestment. Today, when market cap is 15 lakh crore, we are still looking at 50,000 crore divestment, and yet we don't achieve those numbers. So there is a lot of opportunity or scope for growth on revenue side, nominal GDP growth, tax buoyancy, divestment receipts, and some expenditure which we have provided for oil marketing company support, which may not materialize. These are, as finance minister put, realistic numbers. But from a market point of view, one can say that they are conservatively realistic, pessimistically realistic, rather than optimistically realistic.
So, Nilesh bhai, you touched upon the disinvestment point, and I just want to know, will ever, this may be the first year when actually we are going to achieve our fiscal, the divestment number, because ever, whether it was a Congress or BJP or any government, we never achieved our disinvestment target, whether we taken a small or a large. So, do you think that this may be the first time we'll actually achieve, and 50,000, so they just need to divest two companies, 10% each, and it's done. You don't really need to do much. So, will be the
I
first time to strike it right.
I doubt Bharat Bhai in revised estimate also, I think will undershoot divestment target. The government has been fairly comfortable on fiscal deficit thanks to increase in dividend income from PSUs as well as RBI. My guess is that they'll focus more on creating value in PSU before divestment.
That's because a lot of guys are calling for using this beyond this market conditions and this entire environment to really do the divestments which was long been delayed again and again.
So At one point of time, I had recommended someone that we sold Mazgaon Dock Limited at 200 rupee. We should be willing to sell it at 2000 rupee. And they said that you are part of Economic Advisory Council to the Prime Minister. Why don't you raise it?
Understood. Great. Nilesh bhai, one thing which is where basically I think the lot of emphasis is, and which includes entire renewable. I think right from the announcement which was done on 22nd of Jan, a rooftop solar panel, and this they have announced again in the this interim budget as well, including green hydrogen and all. So, what's your view? Is that something which will become a very large industry, and do we really will have a very large industry? Because today we are playing more of a proxies, and there are very few companies really doing the value addition, except the some who are EPC kind of a business. Do we see that this industry will become a large the way we have in say China or other part of the world?
So, Bharat bhai, on energy, I really don't have a view. One, I'm technically not qualified to have an opinion. And second, when we meet experts, we hear completely opposite view. I met someone in Bangalore who said electric vehicle will be failure and green hydrogen is the way forward. I met someone who said neither solar energy nor nuclear energy nor green hydrogen is the future. It is nuclear fusion where you bond two atoms and create energy like a sun. What we saw in Spider-Man's movie where Dr. Octopus was trying to create sun has actually happened in a laboratory in California. They have succeeded twice, failed couple of times, but now they believe this technology will become commercially viable by 2030 and energy prices will become zero. When you go to another segment, they say nuclear is the future, nuclear fission, where we split atoms, is the future for energy. It's clean and it's not as risky as it is perceived. My feeling is that we have to keep our eyes and ears open. One side, we should improve our thermal production, and yes, we have to take care of environment, and which is why coal gasification and coal liquefaction announced in the budget is the way forward. We also have to keep our oil and gas supply intact, and that's where you are seeing Indian Navy in operation in the Middle East corridor. We also have to put our faith on solar energy as we are blessed with solar throughout the year. We also have to focus on green hydrogen because, again, we will be able to move hydrogen in a much more competitive manner than, let's say, solar energy. And we also have to keep a watch on something like nuclear fusion. Who knows if Dr. Octopus becomes alive in real world? We need to have our own Dr. Octopus. So on technology, on energy, keep options open and then ride the wave which you believe is certain.
Thank you. Very insightful. One more point, and I think which you also started with is in terms of the rural consumption and that real gap, right? The recovery has been really, really diverse in terms of the upper band and the lower band, and the really that this one is. Do you think that this budget will be able to get that consumption back, or that you will need beyond this budget? Because that's really been a painful area. Whether when we look at the results from the FMCG companies and the low value items, I think that's really a pain point. And if that doesn't happen, then we'll have that inequality only increasing.
So my feeling is, Bharat Bhai, there is still probably some more need to push for consumption at rural, at middle, at the bottom of the pyramid, and at mass market. IT sector, which was one of our large sector, is not recruiting people. It's actually retrenching people. Remittances and global capability centers are doing well from an employment point of view. Formal sector employment has been growing, but we get mixed data on informal sector. So my feeling is that this budget has moved in the right direction for inclusive growth. And by pursuing the path of fiscal prudence rather than throwing money, it's hoping that private sector will take the lead in job creation. We have to wait and see how this shapes up. If we can supplement budget proposals with ease of doing business on ground, and I'll give you an example. The way we have built Mumbai Trans Harbour Link, if we can do that with every project in public or private sector, I think we don't have to worry about consumption anymore. But the way we have handled Kokhle Bridge in Andheri, which fell down in 2018 partially and which is shut since 2022, and at every stage the deadline keeps on getting postponed, then consumption will require much more support than what is proposed in the budget.
So you're billing that it's more your what enabler which is required rather than a direct one, which she also tried to explain by the fact that it's more empowerment for earning, and the fact is that you are able to earn rather than giving a direct subsidies and trying to do this.
Absolutely.
Uh, right.
Give a man a fish or teach a man fishing. The second option is always
Second is
better than the
always better.
first one.
Yeah, absolutely. I think that's a right path, and that's why this entire focus on capex will bring that in. Manish or Mohit, if you have any questions for Nilesh, I'll invite you guys to ask your questions.
Hi, Nilesh bhai. So, Nilesh bhai, one of the questions which is coming prominently is how do you see markets from here? So, we have two scenarios. One was 2003 to 2007, where everybody thought that markets are overvalued and actually it moved in one direction. And then there was 2014 to 16, 17, where market moved up and then consolidated. So, which phase of market we are in, according to you, and what is the rationale behind that?
So, Manish bhai, if you are taking, let's say, 2024 to 2029, I believe we are in a Tejika market, something comparable to not 2003 to 2008, but more like 2004 to 2006. By 2008 beginning, we were into bubble territory. Markets can always remain irrational, but you can't price in irrationality, and that's why 2005 to 2006. And why not 2003, 2004? Because we are not at that kind of cheap starting point. Markets have run up in expectation and earnings growth are coming. So we are somewhere in 2005, 2007 segment rather than 2003 to 2008. But Manish bhai, as I mentioned earlier, we are trading at a premium valuation to others. And this is justifiably because of good work we are doing, but also partially because of luck, because others are scoring self-goal. Today, global investors can't go to Russia because of Ukraine. They are not going to China wholeheartedly because of the past experience and their design on Taiwan. They can't go to Taiwan because China's shadow is looming large. They can't go to Brazil because they have a communist government. They can't go to South Africa because there is social strife and tension. Effectively, within emerging market, India, Indonesia, Mexico are the few countries which everyone prefers. Because others have scored self goals, people are looking to India even at premium valuation. Tomorrow, if they get their act together, for example, if Russia witnesses change of guard and a pro-Western president comes to power at three times forward earning, everyone will rush there. Then India will suffer. If President Xi Jinping, instead of demolishing Chinese market cap, starts working to enhance it, then people will go to China because it is one third of India's valuation. So a lot will depend upon as how we do. Very, very confident that we'll deliver on those, but also other scoring self goals that we don't know. How long you can assume that people will play against their own team?
Sure. Thanks, Nilesh bhai. The second question, in terms of market valuation, there's a vast difference which has come in between mid cap, small cap, and large cap. So, for a normal investor, how do you suggest that he invests his money? Because I'm saying large caps have seen not so much valuation enhancement, but when it comes to mid cap, small cap, it's almost 45% plus enhancement in terms of valuation. So, there's frothiness which is building in. So, how does the investor look at it?
So, Manish bhai, there is one segment of market where floating stock is very, very limited, and or holding is concentrated in few hands, and they are very reluctant sellers, and hence with limited buying, prices are going up. I believe that segment is worth avoiding. Companies with not so good governance, companies where market price is not necessarily discovered openly and properly, thanks to low floating stock or concentrated holding. All this have given very good return in the past, but I will still recommend stay away from it. You never know when the bubble will burst over there. Bearing those exceptions, I think between large, mid, and small, this is time to be overweight large cap compared to mid and small, because next year's return gap between large and mid and small will narrow down significantly. Uh, Based on your risk return profile, you should be multi cap oriented, some large, some mid, some small. But within the asset allocation, try to be overweight large cap and slight underweight small and mid cap.
Sure. Mohit?
Yeah, good evening, Nilesh bhai.
Good evening, Mohit bhai.
I have a question around, last few years we saw value as a cohort delivering exceedingly well. Nobody could have thought of. And now if I take this question to global parallels, currently it looks like that China is sitting on a very value zone. I thought I'll take your views around that. Is it a good time? Should investors look at investing in China market or something around, beyond domestic as well? I thought I'll take your views.
So Mohit bhai, very correctly, China, Russia, South Africa, Brazil, these are all in value zone. But they are all scoring self goals right now. China has multiple challenges. One, their economy is slowing down because of heavy exposure to real estate. Second, the common prosperity pushed by President Xi Jinping is also resulting into destruction of market cap, as entrepreneurs like Jack Ma are suddenly ejected from their own company. They had a company like Uber in China called Didi. They were forced to leave search pricing. They had companies like Baiju in China in EdTech. They were said you can't now run for profit, become charitable organization. So all this kind of behavior for common prosperity, quote unquote, is resulting into lower profits, unpredictability of future profits, and so on and so forth. And finally, the biggest elephant in for China is their design on Taiwan. Time and again, they are saying that we will, take over Taiwan. The American military is also indicating that it's going to happen earlier rather than later. Now, if you knew Russia was going to invade in Ukraine, will you be brave enough to invest in Russia, even if it's available at 5, 6, 7p? Chances are unlikely. The same challenge is for China. So my feeling is that instead of going into China per se, let's try to create a basket of value stocks globally. Some Brazilian names, some Chinese names, some South African names, some maybe some other countries. Hopefully that basket, even if it has to take a hit of a global event, will still be able to outperform India.
Thank you. One last question. The way I think we had a value breakout after decade, going forward, when you mentioned 24 to 29 is not a similar, what was like 2003 to 8, what Manish bhai asked you. To your mind, what, secular stocks didn't do well in the last few years as compared to value stocks? They still did what maybe the GDP was doing. They also did like that. Some of them were also on the other side as well. To your mind, from here, is one could also come back to the secular strategy while investing?
Yes, to me, I think the market from here onwards is going to be far more bottom up rather than top down. There will be good companies who will do well irrespective of what macro is developing. Our macro is likely to be more stable than rest of the world. And in the rising tide, yes, eventually all boat will get lifted. But someone who is rowing harder, they are likely to lift it first. This is not function of tide anymore. It is also function of rowing, which will lift the boat. So one will have to be bottom-up oriented across multiple sectors to build a portfolio of good quality companies managed by good management. That's your outperformance in the market where so many technological disruptions are happening.
Yeah.
Thank you.
There's one question around global peace. So given that tech companies are doing and there's AI coming in and global technology demand is increasing, and eventually if US Nasdaq companies do well, how do you see the future of Indian companies, especially in tech sector?
So Manish bhai, every Indian company today is saying that we are focused on AI and ML. Every Indian company is saying that we are no longer just infrastructure management or application maintenance company. We are into cloud, we are into digital, we are into security, we are into solutions, consulting, blah, blah, blah. The point is that not only you have to do this, but you have to do better than your peer. You have to do better than your competitor. Everyone is moving in that direction, but the one who is going to run faster is going to win the race. You have to identify within IT companies which are the companies which are leveraging AI and ML to create faster, cheaper, quicker solution for the customers. And this is where men's will be separated from the boys. And I believe select IT companies, be it large, mid, or small, which is running faster than their peer group, should outperform the market.
Amit?
Amit, do you
Amit,
have any questions for Nilesh?
Yeah, Nilesh bhai, hi.
Hi.
Yeah, Nilesh bhai, now so I think many things on our elections are getting discounted, but the US elections are also, in the month of November. That will also have some bearing. So any comments on that? Suppose the current regime is going out and the previous one is coming, then any comment on that?
Sure. So Amit bhai, one, Mr. Trump is quite unpredictable. But if you have to take a call, which as a fund manager, you don't have a luxury, his regime is typically inflationary as he cuts taxes, as he imposes tariffs, and as he focuses on developing domestic industrial base by Make America Great Again. In that kind of scenario, we will see tighter monetary policies by US Fed. Fed rate cuts may not happen as early. Central banks around the world will have to follow Fed, and we may see return of inflationary environment in the Trump regime compared to Biden regime. But anyway, that's post 2024 scenario. From here till November 24, when US presidential elections will be on, I believe Fed will like to support growth so that current president goes on a strong economy pitch rather than struggling economy pitch. While central banks around the world should be independent, at the end of the day, they do report into finance ministry. So I believe US Fed will have much looser monetary policy in second half of CY24 compared to first. And that should be supportive for US growth and global growth.
Right. Thank you.
Thank you, Nilesh bhai. Thank you for your time and
Thank you.
great. Thank you for having it. We will continue. We have Amit, who is going to talk about his take on markets and specifically in context to recent change, which is what been announced. How do he look at the markets now from here?
The private capex to come up. So private capex actually was not coming up. It was more household investment into the real estate, or it was more central government capex. But in the last 12 months, if you see the growth, because the capacity utilization actually has gone to almost 75% in the companies now. And along with this, the real estate cycle is also, picking up after the long lull period. That is where the private capex, when we look at from the listed corporates perspective, in the last 12 months, it has picked up actually by close to 8.1 trillion rupees. And this is where I think, the whole lot of chain linked to this capex will come up. And this is what government was trying to point out, that this private capex would lead to more PSU banks, some corporate linked banks performing better going forward. Possibly, some of the ancillary companies which are beneficiary of this capex the suppliers, they can start getting benefited. So this is where this whole chain starts performing when the capex starts picking up, particularly from the private side. State capex, it was also lacking. So we have seen the government actually is providing the funds so that some kind of initiatives can be taken by the state. So it's a good, positive combo between the states and centers. That is what we are seeing developing. And that is one of the reason, even before budget, 7.1 trillion rupees of capex happened by the states on aggregate basis. So I think the capex cycle is doing good. And it is from the equity market perspective, I think it is when we are managing the portfolios, I think very clearly this is an investment cycle in India. We had not seen such a cycle in the last decade. I understand 2003, 2007 was a very high capex cycle. The GDP size was smaller and we had a pretty high capex in comparison to GDP. And now slowly we are reaching to that because GDP size has also grown. So we are still reaching to that level. We are still, lower than 2003, 2007 capex as a percentage of GDP. That was close to, lower than 3%. Now we are reaching now close to 3.4 in financial year 25. So in that year, we will cross it. So the point is that this investment cycle is leading to many sectors now coming up. And this is where, if you look at PSU as a space, so that space is also, coming up. And I think the direct tax collections from the government, the balance sheet of the government, because it has always happened. Whenever the balance sheet of the government improves, the companies linked to the government, they start performing better. So you can see the numbers now. The government is not borrowing higher, right? This is another very positive which has come out, which has led to the lower bond yields, which can lead to lower cost of capital. And along with this, if you see the GST numbers, direct tax collection numbers, they are also improving actually year on year basis. And that is where I think the PSU stocks have also started performing. Government does not need disinvestment. That is very clearly seen. Like Nilesh Bhai was also mentioning that when the market cap was lower, you had a 30,000 crore of disinvestment. Now the market cap has gone much higher. Even then you have 50,000 crore of disinvestment. Why so? Why don't you need disinvestment? Because your balance sheet is improved. You are getting better cash flows actually from the tax. And not only tax, from the non-tax revenue perspective also, because the PSU companies' profitability has improved. So that dividend also is going into the, the bank, the government side, and which is also helping in coming out with these numbers.
Thank you, Amit. Amit, you covered power and this one, and Nilesh Bhai also spoke about power. How do we really play this theme from here? I think there's a decent run up into lot of these stocks, whether you look at coal, NTPC, or from the PSU side or from the private sector side. There's been a decent run. Do you believe that still there is an opportunity to capitalize on this particular story or the theme, and which part of the power sector story which we can really take it forward?
So I think the power demand is continuously improving now. It has to happen. When you are inviting the outsiders to build in India, manufacturing is coming up. People will start working in couple of shifts. You need more power. And recently, I think from the government, the announcement has come that the connectivity to the villages also is done. And that is where 24 hours electricity, that is a target that they want to provide. So you need more power. And with renewable energy, it is, a process which will grow over the period. But you cannot rely completely on renewable energy. That also we understand. Because if you look at during the day, renewable runs at a capacity of around 40%. You need a base load power to drive that. In the night, obviously, you need a thermal power to drive it. And this is where thermal power capex, actually, if you see from 2015 till 2022, it was degrowing because it was minus 1% CAGR capex. And now if you see from here, we are going to see 20% of CAGR improvement in this capex in the coming 3-4 years. And this is where this whole cycle of thermal power is also improving. There are companies like BHEL, for example, if you see, which is part of our fund. This company was previously dependent more on thermal and it was not performing. Now, if you see the last 3 years revenues of this company, which used to be around 60,000 crore, it has gone up now to 1,80,000 crore because so much of gigawatt through thermal power expansion is happening. And not only this, the companies now have understood, because ultimately these are some of the government companies, and they have understood that they need to diversify their order book. And that is very smartly they are doing. I mean, from the BHEL itself, by financial year 26, that means in another coming 2 years, they will have more than 30% of their order book moving into some other segments beyond thermal power. So they have done the consortium with Titagarh Wagon in the railway wagons manufacturing. They are also moving into defense, which is one of the prime focus of the government. Government in this budget also has allocated more than 6 lakh crore to defense. So BHEL is coming out with some particular guns, very specialized, which are coming only from them to the naval ships. And this is where they are diversifying the order book. And that is the reason the companies have become more smart. And that is where I think the power demand, which was growing by 2.5% before, it is growing by 8.5%, 9% now. And that is the reason that going forward, this is a big story which is opening up. Some movement of stocks has definitely come in, but corrections will come in the market, right? Intermediate corrections will keep on coming. In that case, we need to look at these EPS turnaround stories which are emerging from the power space.
Amit, any further or any particular part of the PSU basket which you believe still have value? I think Pankaj in one of the calls spoke about the PSU bank story, and you just spoke about power. So how do you see the PSU basket? Where do you still see value in the PSU basket?
So I think
Because they already run up a lot, right? I think a lot of guys think that that's the place where the froth is, right? You sneeze it and the stocks are up 10%. They also run from the risk of low float, which all of us acknowledge. And some of the price valuation just not possible to even, put it into an Excel sheet to even figure it out whether they are realistically the price or are we missing some decimals here and there.
So yes, it's a big question actually before the investors, because we have already seen PSU index seeing multiple times of returns actually. And this was the only space which has outperformed many sectors now, or many non-PSU stocks now in the market. So it's a big question. Yes. And we also understand that every rally contains its own leaders. So who knows, these are the new leaders in the market for the coming years. If you understand HDFC Bank, for example, it became 13 times from 2008 to 2020 because there was a lot of money flow came. So money flow has again started, but you are seeing that how the money flow is looking for growth. So particularly from the PSU companies, if you see from 2011 till 2016, this whole PSU index valuation vis-a-vis the Nifty valuation was around 38% of discount. And recently it declined to 68% discount. Now it has recovered to 48%. So still, if it has to go to that 38% discount, you will see 32% of jump actually in the PSU index. That is one possibility. And it can come across the board. So PSU banks also have not performed for the last 1 year or so because NIMs, the top of the major expansion of NIM had already happened. But now once you have seen that the private CAPEX cycle is starting, and previously the corporates, because they had a good cash in books, they were using the internal accruals. But now they are also moving into the banks. So banks corporate lending, which was growing only by 6%, if it starts picking up now more, I think the PSU banks can start performing better. On the top of it, the bond yields actually can remain subdued. We have already seen subdued bond yields in India vis-a-vis US in the last 1 year. Right? US bond yields had moved up very sharply, but not ours. And one of the reasons we discussed was the balance sheet of the government, the lesser borrowing, but also if our bonds are going to be included in the JP Morgan bond index, where $23 billion of flows are expected, then Bloomberg, then Russell, then this particular fiscal deficit prudence which government has adopted, it is really very, very helpful for that. And then the bond yields can remain lower, which can lead to better treasury profits also for the banks. So our sense is this whole basket is encouraging. Somewhere the prices have moved much sharper, so you need to be a little careful, but still opportunities are there. Recently, Mr. Prime Minister had a meeting with the mineral minister actually. So they had a discussion that which are the critical minerals used in India, and that is where we want to get Atmanirbhar. So this is another space which has not performed for the last 15 years, and this is the initial enabler to power, initial enabler to steel, and they can start performing. So government has opened the gates for more mining in India. So this is where opportunities are there. I will not say it has closed or ended. I think it's on us to do more bottom up, what Nilesh Bhai was saying, and identify those opportunities.
So, Amit, you are also
Manish or
known for,
Mohit, you have any questions? Yeah, Manish.
Amit, you are also known for your technical skills. How does technical chart suggest the growth movement from here? Because obviously it could be that we are trading at some premium to our average valuation of last 15-20 years, be it in mid cap, small cap, or large cap, right? So we are no more cheap. So how does technicals play from here? What is the portion which technical shows? Since you also expert on technical side, why don't you enlighten the crowd with or people with that as well?
So see, these levels, definitely market has moved up very sharply in the last couple of months. We have seen a move almost from 19,000 to 21,000 level. So you can say almost 2,500 points very fast. But we also understand that we have spent almost a couple of years actually around 18,500 or 18,000 levels. If you remember in September or October 2021, Nifty had made the top around 18,600. And then after 2021, we spent 2022, there was war erupted, then commodities moved up, inflation went higher, interest rate started moving up. And then 2023 came, when in the beginning we had the collapse of banks in US. So 4-5 regional banks collapsed because of that interest rate hike in the country. And then we saw this whole consolidation happened. Markets had a good reason they could have kept on falling actually in that period, because I saw that US markets in that period, they had come down to the pre-pandemic levels. S&P had the pre-pandemic of around 3,500 and the Nifty had 12,400. But Nifty was 17,000, S&P had reached to 3,500. So 17,000 around only, I saw the skepticism in the market started developing. The market actually was thinking that what has happened to S&P, can it happen to India? And this is where this core story of India is helping to this cause. We have moved from eventually to 21,000 levels, and S&P now is trying to make the new highs, which we have already made. So we are outperformers. We will remain outperformers because our growth is one of the best. You look at the Nifty earnings growth across the developed to emerging markets. So 16-17% of earnings growth you will not find easily. It is only Taiwan which has a higher earnings growth, but Taiwan market, because of Chinese intervention, its price to earning is lower because FIIs, they are not willing to put in money. So FIIs are more willing to put money in India. And that is the reason that whenever our markets comes closer to 5-year average or 10-year average, we see more and more flows from FIIs coming in. The same 19,000 level was close to 5-year average before. And that is the reason when Nifty declined closer to it, before this recent move, then the FI money actually, you have seen that a significant portion came. So my sense is Indian markets can consolidate and time correction may be part of this index, but stock specific opportunities, because the market is getting more broad. I think this is where more research is required, more bottom up exercise is required, more reforms are coming. You need to find the beneficiaries of them, whether it is PSU or non-PSU. So the work of investors has increased. And it is not that the easy money will keep on going on. You will find phases of profit booking, and that is where your stock findings are very, very critical now.
Amit, one question, your view on banking sector. I think there's a gross underperformance by some of the large private sector banks. At the same time, I think you shared your view about the PSU. So maybe if you can just give a broad view on the banking sector and large private sector banks in particular.
So I think private sector banks have not performed that much because they were the previous movers of the last decade. That is very clear. We had very few growth stories in the last decade. That may be the reason that the valuations went higher actually from the private banks on a broader basis. And then once you have more stories coming up now, where more than 20% of earnings growth is expected, the money is moving actually in those areas also. That is also one of the reasons why the liquidity flow is lesser actually in those segments. They can perform because when the valuations become better, the money flow will go there also. And there is no doubt about this. So banking is definitely one of the value space which has not performed. And when our bonds are going to be included outside, I think bond yields lower is good for banks. And the PSU banks particularly, we believe, because if you compare the valuations of PSU banks, still they are reaching to 1% return on asset. And NIMs are also have become better actually than before. So this is where I think the PSU banks can have a better performance vis-a-vis the private. We have to be very, very choosy where the NIMs are better, and where the on adjusted book the return on assets is very, very sticky at the higher levels. I think the money flow will come over there.
Amit bhai, you did so exceedingly well for creating this client's portfolio around the PMS, what you manage, the ACE equity, with I think Nifty performing 24%, and you created an alpha of 23% on that. What's your sense going forward? You were able to identify, along with God's grace, and you were able to identify the right value to growth strategy during last 1 year and since inception of this PMS. What's your sense going forward, that what are the sectors which could be the beneficiary, and which you might be including in your portfolio to see to it that you continue to create alpha always in the portfolio?
So my sense is that this is clearly an investment cycle. From the consumption perspective, you are seeing that the things which are more related to the rural area, they are not able to come up with better results. Volume growth is still lacking. Because one thing is very clear, it's a transition process. The jobs which were lost, actually, the government has to create through the Make in India process. It's a transition. In between, we have seen that the lower middle layer of India, the corporate layer, which is a vendor to the OEMs, that layer actually is doing much, much better now. So that promoter money, the high-end employees, it is actually moving into the high-end discretionary now. So it's a K-shaped consumption recovery, and that we need to play very selectively. Whether it is SUVs as a space which has become 50% of the overall passenger vehicles, small cars actually have left behind, or whether it is consumption from side. If you look at luxury hotels, so hotels from both mid segment or luxury hotels, they were also not the performers in the last 15 years. They are also coming out, right? Yes, they have performed in the initial 2021 move, but afterwards for a 1 year there was a lack in, and then in between we saw the COVID wave. This recently we started hearing the news. But now you are seeing that COVID, came, people had cold and cough, it went off. So again, you have seen that those hotels have started performing. Occupancy is increasing, average room rates have improved. So if somebody has debt in the books, it can be easily paid off. So market is not waiting for the complete debt to be paid off. Market is giving it value before. Take the case of Lemon Tree. So this is how I think the consumption cycle is more high-end discretionary. But yes, there are many sectors which are emerging. You talk about renewables, solar, EV, you talk about active pharma ingredients. There is a lot of room actually in APIs. We understood that mostly it was coming from China. The government is pushing pressure actually now to develop it in India. Whether it is railways, power, telecom, semiconductors, data centers, 5G applications. So there are so many sectors which are emerging now where we are focusing. You look at telecom, the tariff increase actually has not happened since September 2021. And I think post-elections, you will see the tariff increase in the telecom passively. And we believe in the coming 4-5 years, 1.5 times tariff rate increase is possible in the telecom space. And it will remain cheaper because our cost is around $2 per month. Outside, easily $6 per month, you can So there is a good platform for the telecom companies also, and I'm not talking about the 5G applications. That is the extra top up whenever or it is going to come by whatever industry. So there is a leeway in many sectors still, but we also need to understand we need to play selectively now.
So, Amit, you talked about some pertinent things in infra, some pertinent things in power. Now, in fact, in this budget, if you were to see 3.4% is on infra side, and it looks like basically they are very gung on infra. So, any particular companies which are looking in infra, any sectoral subsectors in infra which looks good to you in listed market?
So I think before the interim budget, the government announced almost 27 highway projects. They are opening up. And the construction companies, actually the road construction, somewhere if you compare with the overall market move, they remain, I think, underperformers. So that segment can also start performing if the crude prices are lower. So raw material cost, if it is lower, I think there are segments even in this construction space which can perform. And I think that is what we are looking at. So some of the bigger OEMs in the capital goods space also, which were not performing. You take the case of Siemens, ABB. They also had a long time consolidating in the market. Even Cummins. I think there may be a time for some of these companies to start performing going forward, because this is how this bull market is. The companies spend time correction happens in between, which were not the performers before, they start performing. And that is what we talk about as the sectoral movement from one sector to another sector. And I think this is how this market is going to behave in the coming years. So it may not be a good strategy to buy a stock and then completely forgetting for the coming years. I think some changes in the portfolio is required, and that is where you can amplify your returns.
So thanks. So Amit has been advocating on proactive wealth management and proactive management of your fee, which is a good portion. Bharat, over to you for the closing remarks.
So thank you, Amit, and great insights. And I hope all of you really took away a lot of stuff. I think there are some more questions related to railways, defense, and telecom for you, Amit. If you can just cover these three sectors quickly, I think we don't want to leave these three sectors. They are also equally important.
So yeah, so I think defense I spoke about that the government focus still continues. Now, when government is talking about 1 lakh crore of fund for innovation, so there also they are speaking about the electronics or something, which is going to be used in defense. So there is a lot of technology development which is required. So the focus is very clear. And that is where you need to find opportunities actually going forward in the defense space. It is not going to stop soon. Telecom, I think it's a very broader market. Yes, the number of players in the top companies is very low, and that benefit will go to them. So Bharti Airtel, for example, the average revenue per user, we are expecting it to grow faster. It has already crossed 200, right? And free cash flows are also coming up now. And that is something will drive these companies. So I think they are looking much better. Railway stocks have already performed, right? So it's a common consensus now building up that these stocks have already performed, and there may not be much leeway. But as I said, market gives you time, and in between the few quarter earnings starts coming out. And that is the reason that some consolidation time, because you never know when that time consolidation is starting. It can start, and that is what you need to understand. If you can understand, much better, because you can place that money somewhere else. You can park that money somewhere else in between for a few months, few quarters, and then you can move the money. I think this is how it is. The story is not ending. I think there is a long way in this investment cycle where this outside money, inside money, the domestic institutions money will come and will being parked in these growth stories. The only point is you need to play very patiently, and yes, actively also, in the sense you need to make changes.
Great, thank you, Amit. To just summarize what's really been spoken is that it's been a great budget. It's really changes the entire thought process about India. The fiscal consolidation. The fact is that we are broadly now spending on capital. Our fiscal deficit is now in line with really the capex, and that really tells you that there's no revenue deficit. We are creating a capital expenditure, asset base, and as of all of us know that capital based creation at this speed will really have a multiply effect. and that can really take our GDP numbers to a next level. At the same time, what's really happening into the rest of the world, which will just make sure that and there's no other place in the world except some big tech, and as one of our panelists spoke about Taiwan, where you have a stronger growth than India, but they have their own problems. And in that context, India will be the one which will be working like a magnet to really pull that money as and when is there any liquidity which really want to get parked away. And so with this, let me conclude this. Thank you for your time. Great time ahead for India. It's a India shining story. And as we said, it's our pride to have a fiscal deficit and the budget like this, which will really propel us to a new heights. Thank you, everyone. And thank you for your time. Have a great evening.
Thanks.
Thank you, everybody. Thank you.
Subscribe to our YouTube channel and click on the bell icon to never miss an update from ICICI Direct.